Up until now, we've been talking about service businesses. So a business that earns its revenue by performing a service for customers. In Chapter 5, we're going to look at merchandising businesses. So a merchandiser is a company that earns its revenue by selling merchandise to its customers. So it buys its merchandise from a manufacturer or distributor or wholesaler at one price, and then it sells that merchandise to customers at a higher price, right? So any retail store would be a merchandiser, right? So Walmart, Target, any of the stores up at the mall, those would be merchandisers. And so a merchandiser is going to be more involved than a service business because it's going to have the merchandise inventory account. Merchandise inventory is going to be a current asset shown on the balance sheet, right? And an asset is a current asset if it's going to be used up within a year. We learned that back in Chapter 4. So there's two methods for tracking your inventory, the periodic method and the perpetual. Under the periodic method, this method was more prevalently used before computerized systems were available to businesses because they became inexpensive, and even small businesses could purchase, say, QuickBooks and track their inventory. But the periodic method, the company would not be tracking the amount of their merchandise inventory during the period. They would wait till the end of the period and count up their inventory and then make journal entries to update their merchandise inventory count, kind of similar to what we did with supplies. The perpetual method is where every purchase and sale of merchandise inventory is recorded. So anytime you have a transaction with merchandise inventory, we make a journal entry to update the merchandise inventory account. Okay, so when we buy merchandise inventory, right? So if we're purchasing merchandise inventory, an asset, the asset is going up, it goes up with the debit. So we'll be debiting merchandise inventory when we when we buy it. And when we sell merchandise inventory, we will credit the merchandise inventory account to show that account going down because we're always wanting to keep the most updated balance of merchandise inventory. And we're going to see when we sell merchandise inventory and we credit the merchandise inventory account, we're going to debit an account called cost of merchandise sold or cost of goods sold. Okay, those terms are used interchangeably. So we've got some additional accounts for a merchandising company. We already said merchandise inventory isn't an account that a merchandiser has that a service business doesn't have. The revenue account for a merchandising company is going to be called sales revenue rather than service revenue. And now we're going to have this cost of goods sold or cost of merchandise sold account. So if you're using the perpetual system, you are going to have this account used. The periodic system does not use a cost of goods sold account because they don't make journal entries to update merchandise inventory during the period. And then we're going to see the income statement is going to be more involved for a merchandising company. And this isn't an account. They don't have an account called gross profit. This is going to be a line item on the income statement. Okay. So let's take a look at our income statement for a merchandiser. We learned for the service business, our income statement showed our revenue, then our expenses, and then we subtracted revenue minus expenses and we got to net income. With a merchandiser, we are going to be doing a multiple step income statement. And so the multiple step income statement, we're going to have a series of subtotals. It's not just going to be one step, revenue minus expenses. We're going to be doing several subtractions, multiple subtractions on our way down to getting to net income. So we said net sales revenue is not the amount we charge our customers for the merchandise. And cost of goods sold is going to show what we paid for the merchandise that we sold. Right? So we know that we buy the merchandise at one price. Okay, so the cost of goods sold is what we paid for the merchandise. The sales revenue is what we charge the customer for it, right? We charge the customer more than what we paid for it. That's how we're making money as a merchandiser. And so then we're going to have our first subtotal on the income statement called gross profit. We take our net sales revenue, subtract our cost of goods sold. That gives us our gross profit. Then we're going to subtract our operating expenses. And so our service company, all of their expenses were operating expenses. So we're going to see some similarities here. So our operating expenses are going to be broken down into two categories: selling expenses and administrative expenses. Our selling expenses are going to be anything having to do with the sales function. So your salespeople's salaries, advertising expense. Now we've got to, if we are paying costs to deliver the items to our customers, we have delivery expense. Anything having to do with the store supplies, depreciation on the store, right? Those are all going to be selling expenses. And then your administrative expenses are basically your office type expenses. Anything that's not selling really falls under administrative expenses. So your office people's salaries, your rent on your office, your utilities on your office, insurance on your office. Those are all going to be your administrative expenses. And so your selling expenses plus your administrative expenses, that gives you your total operating expenses, which are subtracted from gross profit, and then we get our operating income. And so after our operating income, we're going to then show our expenses from our revenue and expenses from outside the operations. This is our other revenue and expenses. And so for the most part, your other revenue and expenses are going to be your investment type revenue and expenses. So dividend and interest income, rental income, if you had some rental property, right, that was outside of your operations, that rental income would be shown there. Interest expense would be another expense. And then we'll talk about this in a later chapter, but any gains or losses from selling your fixed assets. So if you sold some of your equipment at a gain, that would be an other revenue or other income. If you sold, equipment or a computer, you sold it at a loss, that would be an other expense. So what we'll do is we'll combine all of our other revenue, combine all of our other expenses, and then we subtract the total other revenue and the total other expenses. And we know that revenue makes our net income higher, expenses make our net income lower. So if the other revenue is higher than the other expenses, the difference between the other revenue and other expenses is going to be added. If the other expenses are higher than the other revenue, then the difference is going to be subtracted. And that's going to get us to our operating income. Our income before taxes. And so after our income before taxes, then we subtract our income taxes and we get to net income. So that's the formal way of doing it. That's the correct way of doing it. And we're going to do you're going to be doing a financial analysis assignment where you're looking at a real company's financial statements, and you'll see that they do come to income before taxes and then subtract income taxes. For our purposes, we are just going to subtract the other revenue and expenses from our operating income and come to net income. We're going to skip the income before taxes and income taxes, not because it isn't important. It's very important. Everything that a company does has a tax consequence, and companies, they spend a lot of time and effort and money looking at ways to minimize their tax liability. So I'm not saying it's not important. It's just it's so important and so complex that income taxes is a whole other class. We have so much that we're going to learn that we can't even get into the taxes in this class. So you're going to see that we're going to skip the income before income taxes and we're just going to come to net income just for our purposes. But the real way of doing it is we have the income taxes. And so I want to show you an example of a multiple step income statement. Okay, so we're going to prepare the income statement for McGill Enterprises. So we know the first thing on any income statement is revenue. Since they're a merchandiser, their revenue is called sales revenue. And they have $5,600 of sales revenue. After sales revenue, then we show our cost of goods sold. And their cost of goods sold is $2,500. So this is the first step on our multiple step income statement. We're going to take sales revenue and subtract cost of goods sold, and that is our gross profit. Okay. So after gross profit, then we show our operating expenses. And for operating expenses, we have selling expenses of $1,500. And we have administrative expenses of $900 for McGill. So our total operating expenses $1,500 plus the $900 are $2,400. Okay. So now we can do our next step, and that is to subtract the gross profit minus the total operating expenses, and that gives us operating income. Okay. And so our next step is to show our other revenue and expenses. So these are the revenue and expenses outside of operations. It's typically your investment revenue and expenses. So this company has interest revenue of $150 and interest expense of $400. Now, I believe in my accounting lab, they're going to have you enter the interest expense as a negative. Revenue increases our net income. Our expenses decrease our net income. So we're going to subtract. So our total other revenue and expenses then is going to be a subtraction. Oops, I went the wrong way. Of $250 when we combine the $150 revenue and the $400 expenses. The difference is $250. Since the expenses are higher, we are subtracting $250. And so then we can come to our net income, because we said we're not going to be doing the income before taxes and income taxes. We are going to skip that step. So $450 then would be our net income. So that's what a multiple step income statement looks like for a merchandiser. Our first step is to subtract sales revenue minus cost of goods sold to get to gross profit. The next step is gross profit minus total operating expenses gets you to operating income. And then our next step is operating income plus or minus your other revenue and expenses to get to net income, right? In this case, it was a subtraction because our other expenses were higher. If our other revenue is higher, then we are added. So that's what the multiple step income statement looks like.